Ever stared at your paycheck, watched those numbers dwindle from your gross pay to your net, and just thought, where did it all go?
Uh-huh.
Or maybe you're already feeling that familiar pre-tax season anxiety, overwhelmed by the thought of forms and figures. Well, you are definitely not alone.
Oh, yeah.
And that's exactly why we're here today.
It's a universal experience, isn't it? Feeling a bit in the dark about what happens between your hard-earned income and what actually lands in your bank account.
Totally.
Understanding these mechanisms isn't just about compliance. It's absolute key to, achieving financial peace of mind.
That's spot on. Today, we're taking a deep dive into mastering federal tax withholding and getting a firm, confident grasp on estimated tax payments.
Right.
Our mission. To take a stack of essential IRS insights straight from their very own publication 505, which is just packed with critical details, and break down the most important nuggets of knowledge for you.
Think of it as a shortcut.
Exactly. Your personal shortcut to feeling truly well-informed, giving you surprising facts, and crucially, practical strategies that you can put into action right away.
Things you can use now.
To manage your taxes effectively throughout the entire year, we're going to help you accurately manage your taxes, avoid those unwelcome surprises, and really leverage the available mechanisms to optimize your financial situation, putting more control in your hands.
And when we talk about optimizing, we're not just speaking in abstract terms. We mean making sure you're not unintentionally giving the government an interest-free loan by overpaying.
Right.
Nor underpaying and potentially incurring penalties. It's all about being proactive, not reactive, ensuring your money is working for you, not against you.
Okay, let's unpack this crucial topic, starting with the very foundation. Understanding what withholding is and why it matters so much in your financial life.
Good place to start.
At its core, federal income tax is primarily withheld directly from the pay of most employees. And when we say pay, we're not just talking about your regular hourly wage or salary. This is comprehensive.
It covers more.
It also includes things like bonuses you might receive, commissions from sales, vacation allowances, and even certain reimbursements you might get under what the IRS calls non-accountable plans.
That's right. The term non-accountable plans basically means expenses where you, as the employee, aren't required to provide detailed receipts or fully account for how the money was spent to your employer.
Okay.
Because of this lack of strict accountability, those reimbursements are generally treated as taxable income and are subject to withholding, just like your regular wages.
Ah, good distinction.
Yeah, it's important to understand that because many people assume all reimbursements are tax-free, and that's not always the case. What's fascinating here is that your employer isn't just pulling a random number out of thin air when they withhold your taxes.
No magic involved.
Right. They're using very specific information you provide on Form W-4, the Employee's Withholding Certificate, to figure out how much tax to withhold from each and every payroll period. It's a direct reflection of the data you give them.
And there are some interesting nuances to this. For example, military retirement pay, even though it's classified as a pension for some other tax purposes.
Right, different label sometimes.
It's treated just like regular pay for income tax withholding. On the flip side, for non-cash wages, think things like certain fringe benefits or goods provided in lieu of cash.
Okay.
You actually have to ask your employer to withhold income tax. If they don't agree to do that, or if what they withhold isn't enough, then you might need to turn to estimated tax payments to cover that liability yourself.
Which immediately highlights how proactive engagement with your withholding isn't just a suggestion, it's absolutely crucial for avoiding surprises.
It really is.
This raises an important question that every listener should be asking.
Yeah.
Why is accurate withholding so critical? It's really about finding that Goldilocks principle, not too much, not too little, but just right.
Just right.
The ideal scenario, the one we're aiming for, is when your withholding perfectly matches your actual tax liability for the year.
Yeah.
This precision allows you to optimize your cash flow throughout the year.
Right. Because if you underwithhold, meaning you haven't paid enough tax during the year, through either withholding or estimated payments, the IRS can hit you with a penalty.
And nobody wants that.
No, and nobody wants to just hand over extra money that could have been earning interest for you or paying down debt. It's essentially a penalty for not planning adequately, for not having your money where it needs to be when the government expects it.
It's a direct financial consequence of inaction.
Exactly.
Conversely, if too much tax is withheld, you lose the use of that money throughout the year. You're effectively giving the government an interest-free loan until you receive your refund.
Which could be months later.
Months later, imagine that money sitting in your bank account, earning interest, or helping you meet immediate financial goals like building an emergency fund or paying down high-interest debt.
Yeah.
So overwithholding, while it might feel safe to some, isn't always the most financially savvy approach. It's leaving your money on the table, or rather with the IRS, for longer than necessary.
So proactive management here isn't just a good idea, it's a key strategy for financial optimization. You absolutely must check your withholding regularly,
Regularly, that's key.
especially when personal or financial changes happen, or even when tax laws shift, as they sometimes do.
Yeah.
The IRS even provides a helpful Table 1-1, which is essentially a checklist of personal and financial changes that should prompt a review.
Like what kind of changes?
Well, big life events like marriage or divorce, the birth or adoption of a child, buying a new home, starting a new job, getting a significant raise, or changes in taxable income not subject to withholding,
Right.
and even filing for Chapter 11 bankruptcy. Any of these events can significantly throw your withholding off balance, leading to those unwanted surprises we just talked about.
Yeah.
It's really about seeing your W-4 as a living document, not a one-and-done form you fill out once and forget.
Absolutely. And if we connect this to the bigger picture, regularly reviewing your withholding is a significant, entirely legal tax-saving strategy. Well, it's not about illegally avoiding taxes, obviously. It's about ensuring you don't unnecessarily overpay throughout the year and lose out on that money's potential, or underpay and get hit with penalties.
Okay, makes sense.
It's about smart financial hygiene, putting you in control of your cash flow rather than letting the IRS dictate it.
Right. Okay, here's where it gets really interesting and where we dive into the practical how-to of managing your taxes year-round. Your primary tool for all of this is Form W-4, the Employee's Withholding Certificate.
The W-4.
The big one. This is the central document you provide to your employer that tells them exactly how much income tax to withhold from your paycheck. It's your control panel for federal income tax withholding.
And it's crucial to understand when to file a new W-4 because it's not just for when you start a new job.
Definitely not.
Obviously, when you start a new job, you must fill one out and provide it to your new employer. But beyond that, there are specific situations where you are required to furnish a new W-4. This is important for avoiding those penalties we discussed.
Yes, this is paramount for compliance and avoiding penalties. If a change in your life will result in less withholding than your expected tax liability for the rest of the year.
Meaning you won't have enough taken out.
Exactly. You are legally required to furnish a new W-4 within 10 days of that change. So what kind of changes are we talking about?
Give us some examples.
Well, if your filing status shifts, for instance, going from married filing jointly to single, or if you or your spouse start another job, especially if you initially use the multiple jobs worksheet or the tax withholding estimator.
Those tools we'll talk about later.
Right, and that calculation relied on specific assumptions about only one job. It also applies if you or your spouse get a significant raise. We're talking more than $10,000 at a second or third job, and you didn't check the Step 2C box on your W-4s for multiple jobs.
Okay, that's specific.
Very. Other triggers include a significant decrease in your expected child tax credit or other credits by more than $500, or a decrease of more than $2,300 in your expected deductions.
So big swings in credits or deductions.
Yeah. And of course, if you no longer reasonably expect to claim exemption from withholding, a common mistake for students entering the workforce, you must update your W-4. Failing to update your W-4 in these situations can lead to underpayment penalties.
And one aspect that often surprises people is the distinction between required and optional changes. While the IRS mandates updating your W-4 if your withholding will become insufficient.
Right, you have to do that.
You can file a new W-4 whenever you wish if a change results in more withholding than your tax liability.
So you can adjust downwards if needed.
Exactly. This gives you incredible flexibility to adjust proactively. For instance, if you anticipate larger deductions or credits in the coming year and want to reduce your withholding to have more take-home pay sooner, you don't have to wait.
You can get that cash flow benefit right away.
Make that adjustment right away, effectively improving your immediate cash flow.
And a very important word of caution here. The IRS keeps an eye on this. They can review your withholding, and if they determine you've overstated your claims or perhaps can't legitimately claim exemption,
They can step in.
they'll issue what's called a lock-in letter to both you and your employer. This letter specifies the exact withholding arrangement your employer must use, overriding your W-4 if it's inconsistent.
So the IRS can mandate your withholding.
They can. This isn't just a threat, it's the IRS signaling they're actively monitoring compliance. It's a direct reminder that your W-4 isn't a set-it-and-forget-it form, but a live document that's tracked.
And be warned, there's a serious penalty for supplying false information on Form W-4, as that could be considered tax evasion. This is a serious reminder that accuracy is not just about convenience, but strict compliance.
Definitely serious.
Absolutely. Moving on to the actual mechanics, Form W-4 is structured into 4 main steps, each designed to gather the precise information needed for accurate withholding. Let's walk through them,
Okay.
because this is where you can truly understand and optimize your tax situation, turning what seems like a bureaucratic form into a powerful financial tool.
Step 1 is foundational: personal information and filing status. This seems straightforward, but it's where everything else starts.
The building block.
Your anticipated filing status, whether you're single, married filing jointly, head of household, or married filing, separately directly influences the standard deduction and the tax rates your employer uses to calculate your withholding.
Yeah, getting this wrong throws everything off.
It really does. Getting this right is the absolute first step to accurate tax management, and errors here can ripple through your entire tax calculation.
Step 2 is where it gets really interesting and impactful for many households. Multiple jobs or spouse works.
A common situation.
Very. If you hold more than one job at a time, or if you're married filing jointly and your spouse also works, completing this step is vital for accurate withholding.
And how does the IRS suggest handling that?
Well, the source specifically suggests completing steps 3 through 4B, those are the adjustment steps, on only one Form W-4, just one, ideally for the highest paying job. This approach is recommended because it concentrates your adjustments in one place, leading to the most accurate withholding and preventing either significant under or over withholding throughout the year.
Avoids double counting adjustment.
Exactly. It's a common pitfall for those with multiple income streams.
So this is a key optimization point. It's like having multiple throttles on an engine. You want to adjust the most powerful one to get the right speed. Don't double dip on your W-4 adjustments if you have 2 jobs.
Or you'll likely be way off.
Way off, either owing a lot or getting a huge refund that could have been in your pocket all year. Then we get to step 3, claiming dependents and other credits.
The direct tax-saving lever.
Yes, this is truly your direct tax-saving lever, a powerful way to reduce the tax withheld from your paycheck. This is where you account for things like the child tax credit and the credit for other dependents, estimating your eligibility for these.
And it's not just dependents.
Right. You can also include estimates of other tax credits here, such as education credits or even the foreign tax credit.
Indeed, this is a powerful area for immediate tax savings throughout the year. The IRS provides a worksheet 1 to 6, specifically for figuring out the total amount of estimated tax credits to include in Step 3 of your W-4.
So there's a tool for that.
Yes. By accurately estimating and including these credits, you are directly reducing the tax withheld from your paycheck. This means more money in your pocket with each pay period rather than waiting for a refund next year.
Leveraging those credits immediately.
Exactly. It's about immediately leveraging those credits to improve your cash flow.
That's fantastic. And then there's step 4, other adjustments. This optional step allows for even further fine-tuning and precision, giving you maximum control over your withholding.
More dials to turn.
First, you can account for other income, not from jobs. If you have income from side gigs like freelancing or driving for a rideshare service, or if you have significant investment income or other sources that aren't subject to withholding.
Income your main job doesn't know about.
Right, you can factor it in here. This helps ensure you don't underpay your taxes throughout the year and face a penalty later by building that liability directly into your paycheck withholding.
Smart. Then there are deductions beyond standard deduction. If you anticipate itemizing your deductions, meaning your total eligible itemized deductions exceed the standard deduction for your filing status.
Like mortgage interest or large charitable donations.
Exactly. Or if you have other significant deductions that will reduce your overall taxable income, you can adjust your withholding here to reflect that. This is another smart way to prevent overwithholding.
Because your taxable income will be lower.
Right. It allows your withholding to more accurately reflect your true tax burden.
And finally, under step 4, you can specify any additional amounts you want to withhold. This is incredibly useful for strategic tax management.
Total control here.
It's where you can tell your employer to withhold an additional specific dollar amount from each paycheck. This is particularly beneficial if you anticipate specific liabilities that aren't typically covered by standard withholding, like the additional Medicare tax or net investment income tax, NIIT.
Which we'll touch on more later.
Yes. Or, simply, if you just want to ensure you have enough withheld to avoid a large year-end tax payment or even a penalty. It's a proactive, personalized measure to avoid surprises and headaches come tax season.
Let's look at a practical example from the source to truly illustrate how these W-4 adjustments can make a real difference. Imagine a couple. Let's call them Alex and Ben.
Okay.
Alex earns $46,000 a year, and Ben earns $68,000. On top of their salaries, they have an additional $184 in taxable interest from investments and $1,000 of other taxable income from a small side venture. They're filing a joint return.
Pretty typical scenario.
Right. After going through the IRS worksheets specifically, worksheets 13, 14, and 15 from Publication 505, which guide them through calculating their total tax, taking into account their incomes, and any credits they determine they will actually owe an additional $4,459 after their regular withholding is considered.
Ouch. That's a big chunk of change to owe unexpectedly.
It is a significant unexpected tax bill.
So what do? Instead of waiting until tax season to pay that lump sum and potentially facing a penalty for underpayment,
Which they might.
they can proactively distribute that $4,459 between their two jobs. Let's say Ben has 49 pay periods left in the year.
Okay.
He could then choose to add approximately $91 to his Form W-4 in Step 4C for each remaining payday. $4,459 divided by 49 paydays.
Spreading it out.
Exactly. This ensures they pay their full tax liability throughout the year, avoiding that big payment at the end of the year and any potential penalties. This is smart tax management in action.
It really is. Turning a potential stressor into a manageable incremental payment, it prevents that painful realization when you file your return.
And this really highlights the flexibility within Form W-4. You can fine-tune your withholding to such a degree that it precisely matches your anticipated tax liability,
Hitting that sweet spot.
preventing the need for a large payment or, equally, a significant refund, both of which represent money that wasn't actively working for you throughout the year.
It's about precision in your tax planning.
And there's a special circumstance called the part-year method. This is a really clever option for those who work only part of the year.
Like students working summers or someone starting mid-year.
Exactly. Perhaps if you started a new job mid-year or you have seasonal employment,
Right.
if your employer agrees to use this method, and that's an important caveat, they have to agree.
Employer cooperation needed.
Less tax will be withheld from each wage payment than would be if you worked a full 12 months. This is a great way to avoid over-withholding, meaning more money in your pocket throughout the year rather than waiting for a refund.
Gives you immediate access to your money.
It allows your withholding to accurately reflect your shorter work period, giving you immediate access to your funds rather than waiting for a refund next year. It does require employer agreement and consistent payroll periods, but it's a direct cash flow optimization strategy that many overlook.
Okay, so that covers wages pretty thoroughly. Now, let's move beyond traditional wages and explore withholding for other types of income, because not all income is treated the same when it comes to taxes.
Right, different rules apply.
First, there's sick pay. If you receive sick pay from a third party, not directly from your employer, perhaps through an insurance company,
Okay.
federal income tax can be withheld by request using Form W-4S. If you don't arrange for enough withholding, or if not enough is withheld, then estimated tax payments may be needed to cover that income, just like any other non-wage income.
Got it. Form W-4S for sick pay.
Then pensions and annuities. This generally includes distributions from IRAs, life insurance contracts, and various deferred compensation plans.
A big area for retirees.
Absolutely. The general rule is that income tax will be withheld from these distributions unless you specifically choose not to have it withheld.
Ah, so it's opt-out, not opt-in.
Exactly. This is a key difference from wage income, where you generally can't opt out of withholding unless you meet very strict exemption criteria.
Okay.
It's important to clarify that the non-taxable part of your pension or annuity, which is essentially the return of your original investment, isn't subject to withholding.
Only the taxable part gets withheld on.
Correct. The tax withheld will only be figured on the taxable portion of your distribution. For periodic payments from a pension or annuity, withholding is figured similarly to wages. You tell your payer how much to withhold using Form W-4P.
Another W-4 form, W-4P this time.
Yes. However, a crucial point for managing your cash flow is that if you don't provide a Form W-4P, tax will be withheld as if your filing status is single with no adjustments.
The default could be costly.
It could easily lead to over-withholding if you're actually married, have dependents, or have other credits, effectively tying up your money unnecessarily.
And for non-periodic payments, like a lump sum.
Things are a bit different. These are typically subject to a flat 10% withholding rate by default.
Just a flat 10%.
By default.
Yeah.
However, you have significant control here. You can choose a different rate anywhere from 0% to 100% on Form W4R Line 2.
Wow. 0 to 100%. That's huge flexibility.
It is. This is a significant point for managing your cash flow, as it gives you the flexibility to take more of the payment upfront if you need immediate funds, or have more withheld if you anticipate a larger overall tax bill for the year and want to proactively cover it.
A powerful tool for retirees or those receiving one-time distributions.
And what's particularly notable about pensions and annuities is that you generally can choose not to have tax withheld, regardless of your prior or expected tax liability.
Unlike wages.
Right. You don't have to qualify for exemption in the same strict way you do for wage income. This offers considerable flexibility for retirees to manage their income and estimated tax payments, allowing them to coordinate their tax payments with their overall financial planning more precisely.
Here's a crucial one for anyone receiving what are called eligible rollover distributions, or ERDs, from qualified retirement plans like 401ks.
Important for job changers or retirees rolling money over.
Yes. These are subject to a mandatory 20% default withholding rate on the taxable amount. The key here is that you cannot choose less than 20%. You can't even choose 0%, even if you intend to roll the full amount into another retirement account.
Mandatory 20%, no choice there.
That 20% is held back automatically. However, you can choose a rate higher than 20% on Form W4R. This 20% is a default, not necessarily your final liability, so it's essential to consider your overall tax picture and plan to roll over the full amount, even if 20% was withheld.
Meaning you might need to add funds from elsewhere to complete the rollover?
Exactly. Otherwise, that 20% becomes a taxable distribution, potentially with penalties.
Okay, good warning. Next, let's look at gambling winnings, which have their own set of rules.
Feeling lucky. Need to know this.
A flat 24% income tax is withheld from certain gambling winnings, including $5,000 from sweepstakes, wagering pools, or poker tournaments, or if the proceeds are 300 times the amount of the bet.
Flat 24% above 5K or 300x the bet.
Right. It doesn't matter if your winnings are in cash, property, or an annuity. The fair market value applies.
But there are exceptions. Winnings from bingo, keno, and slot machines are generally not subject to income tax withholding.
Interesting exceptions.
Though, you might still need to provide your Social Security number to the payer to avoid backup withholding, which is a different type of mandatory withholding.
No cap at the holding, okay.
If you receive gambling winnings not subject to withholding, you'll definitely need to consider making estimated tax payments to cover that income. For these winnings, the payer will give you Form W2G, showing the amount you won and any tax withheld.
Got it. W2G for gambling.
You also need to provide them with your name, address, SSN, and details on identical wagers, or if someone else is entitled to the winnings, which might require Form 5754.
Lots of paperwork, potentially. We also have unemployment compensation, if you're receiving unemployment benefits.
Which many people experienced recently.
Yes. You have the choice to have income tax withheld from that compensation by filling out Form W4V.
W4V for voluntary withholding on unemployment.
Correct. This is a convenient option to avoid a large tax bill at the end of the year on income that might otherwise be overlooked for tax purposes. Similarly, for shareholders of Alaska Native Corporations, or ANCs,
Okay.
you can request income tax withholding from dividends and other distributions using Form W4V again. If you don't choose to have tax withheld, or the ANC doesn't accept your request, you may have to pay estimated tax to cover that income.
So again, planning ahead is key, maybe using estimated tax.
Absolutely.
Okay, so we've covered how withholding works for various income types, from your regular paycheck to pensions and even gambling winnings. But what happens if that's still not enough to cover your tax liability? Or if you have significant income not subject to withholding at all?
The gaps in withholding.
Exactly. That brings us to Section 3. The safety net and advanced management estimated tax and other considerations. This is where you avoid those dreaded end-of-year tax bill shocks and truly complete your tax management picture.
Precisely. The core purpose of estimated tax is to pay tax on income that isn't subject to withholding. This commonly includes very important sources like self-employment income, if you're a freelancer or gig worker.
Big one for the gig economy.
Huge. Also, interest from investments, dividends, rental income from properties, gains from asset sales, prizes, and awards. You may also need to pay estimated tax if the amount withheld from your salary or pension isn't sufficient to cover your total tax liability for the year.
So it fills the gaps.
It's a critical component of tax planning to avoid penalties and is especially vital for entrepreneurs and investors.
And that penalty threat is very real. The IRS explicitly states that if you don't pay enough tax during the year through withholding, estimated payments, or a combination of both, you may have to pay a penalty.
They don't mess around with that.
No. So, understanding when you need to pay estimated tax is a direct, proactive tax-saving strategy in the sense that you avoid losing money to those penalties. It's not just about paying your taxes, it's about paying them on time throughout the year.
Timing matters. The general rule for needing to make estimated tax payments is often called the 90% 100% test.
The 90-100 test.
Okay, this is the IRS's guideline for ensuring you've paid enough. You generally must make estimated tax payments if you expect to owe at least $1,000 in tax for the year, after subtracting any income tax withholding and refundable credits you might have.
Okay, $1,000 threshold first.
And here's the kicker. Your withholding and refundable credits must be less than 90% of the tax shown on your current year's return,
90% of this year's tax.
or less than 100% of the tax shown on your previous year's return, provided that previous year's return covered a full 12 months.
Or 100% of last year's tax. That's the safe harbor.
Exactly. This means you have a safe harbor if you just match last year's tax bill through withholding and credits.
And for those higher income taxpayers out there, if your adjusted gross income, or AGR, was over $150,000 in the prior year, $75,000 if married filing separately.
The threshold changes.
Right, that 100% rule for the prior year jumps to 110%. So it's a slightly higher threshold to meet if you're a high earner.
110% of last year's tax for higher earners.
Meaning the IRS expects you to pay a bit more of your prior year's tax to be safe. And farmers and fishermen get a break where that 90% threshold drops to 66-23%, acknowledging their often fluctuating income.
Right.
The IRS recommends using their estimated tax worksheet or worksheet 2.1 in publication 505 for an accurate calculation, especially if that general rule suggests you might owe.
Use the worksheet to be sure.
This worksheet really helps you pinpoint your estimated liability.
This raises an important question. What specific taxes might require estimated payments beyond just your standard income tax? Two key ones are the additional Medicare tax and the net investment income tax, or NIIT.
Okay, what are those?
The additional Medicare tax is a 0.9% tax and applies to Medicare wages, Railroad Retirement Tax Act compensation, and self-employment income above certain thresholds. For example, $200,000 for single filers or $250,000 for married filing jointly.
An extra 0.9% on top.
This is often an overlooked liability that can sneak up on taxpayers, especially successful freelancers or small business owners.
And then there's the NIIT.
The net investment income tax, a 3.8% tax that applies to the lesser of your net investment income or the amount by which your modified adjusted gross income, or MAGI, exceeds similar thresholds, $200,000 for single, $250,000 for married filing jointly.
3.8% on investment income above those levels.
Think capital gains, dividends, interest, rental income, all of those investment sources can be subject to this. Both the additional Medicare tax and NIIT might necessitate estimated payments. Or, here's another optimization point. You can also request your employer deduct an additional amount on Form W-4 to cover these taxes if they're applicable to your wage income.
Use the W-4 additional withholding again.
This gives you flexibility. Rather than having to make separate estimated payments, you can simply have it come out of your paycheck like regular withholding.
Makes it simpler. Speaking of payments, how do you actually pay estimated tax?
Good question. The tax year is effectively divided into 4 payment periods, each with a specific due date. It's crucial to meet these deadlines.
4 deadlines throughout the year.
Yes, because penalties can apply even if you are ultimately due a refund when you file your return, if those payments weren't made by their respective due dates.
So don't assume a year-end refund will erase all past sin.
Exactly. That's a classic trap. You get a refund, but still owe a penalty because you didn't pay your estimated taxes on time throughout the year.
Okay, so pay on time. But what if your income isn't steady?
That's where another advanced management technique comes in, the annualized income installment method.
Annualized income, what's that?
This is a lifesaver for those with income that fluctuates significantly throughout the year, like seasonal workers Or someone who anticipates a large capital gain later in the year from, say, selling a stock or a piece of property.
Like that freelance graphic designer example.
Exactly. What's fascinating here is that this method allows you to pay estimated tax based on your income as it's actually earned, rather than in 4 equal installments.
So payments match income flow?
Precisely. Imagine you're that freelance graphic designer, and you know you'll earn very little in the first quarter, but then you land a massive contract in the summer. Using the annualized income installment method, you could potentially make smaller estimated payments earlier in the year.
Improving your cash flow early on.
Right, until your income ramps up later. You would use the IRS's annualized estimated tax worksheet, Worksheet 27, to figure this out. It's a very sophisticated way to manage your tax burden in real time.
Making your tax payments align more closely with your actual income flow. Very useful.
And the good news is, the IRS has made paying estimated tax incredibly convenient with a variety of methods.
How so?
You can pay online through your IRS online account at irs.gov account, where you can also view your balance, payment history, and tax records. It's a powerful personal tax hub.
The online account seems key.
It is. There's IRS Direct Pay, which is a free direct transfer from your bank account, or you could use a debit or credit card or digital wallet, though those come with a service fee from a third-party processor.
Watch out for fees then.
Yeah. You can even set up electronic funds withdrawal when you e-file your taxes. For businesses and individuals, the Electronic Federal Tax Payment System, or EFTPS, is available, and it's free, but requires enrollment for security purposes.
EFTPS sounds good for regular payments.
It is, often preferred for businesses or those making regular, recurring estimated payments. Beyond online options, you can pay by phone through debit credit card service providers or via EFTPS once enrolled.
Mobile app too.
Yes. For mobile users, the IRS To Go application offers convenient payment options right from your smartphone. You can even pay by cash at participating retail stores across the country.
Pay cash at a store.
Yeah, but remember, a crucial safety tip: never send cash through the mail.
Definitely not.
And of course, the traditional method of paying by check or money order is still available, mailed with payment vouchers from Form 1040-ES. Just be aware of the $100 million single check limit.
Huh. A problem I wish I had.
Right. If you're paying more than that, you'll need multiple checks.
Okay, so we've covered the what and the how of withholding and estimated payments. But the biggest takeaway, and a truly crucial component for your financial well-being and a major tax-saving strategy, is continuously and proactively managing your withholding.
It really boils down to staying on top of it.
This is about continuous optimization and potential real savings in your pocket.
A key takeaway here is the emphasis on regular review. The IRS themselves stresses the importance of checking your withholding regularly to ensure it aligns with your actual tax liability.
Not set it and forget it.
Definitely not, because your life isn't set it and forget it. Your financial situation changes, and your tax strategy needs to adapt with it.
And the IRS provides an incredible free online tool to help you do just that. The Tax Withholding Estimator at irs.gov W4 app.
That estimator is really useful.
It is. This is an easy way to determine if your withholding needs adjustment, whether you need to increase it to avoid a UN bill or decrease it to have more take-home pay. It helps you see how changes to your withholding affect your year-end refund, your take-home pay, or the tax due.
Takes the guesswork out.
This tool is a direct path to tax optimization, taking the guesswork out of a critical financial decision. We highly recommend using it at least once a year or whenever you have a significant life change.
This really connects to the earlier point about the Goldilocks principle.
Yeah.
The estimator allows you to actively seek that balance.
Find that just right amount.
Exactly. You should absolutely reevaluate your withholding whenever those personal and financial changes listed in Table 1.1 occur. Marriage, divorce, birth of a child, buying a new home, retirement, starting a new job, taking on a second job, getting significant raises, or changes in non-withheld income.
All those life events again.
These are all triggers for review, allowing you to proactively save by adjusting your withholding and ensuring your money is working for you, not sitting idle with the government.
And now for what might be one of the biggest tax-saving strategies of all, if you qualify, exemption from withholding.
The zero withholding options.
Yeah. This means your employer won't withhold any federal income tax from your wages. However, it's absolutely crucial to understand the strict criteria here.
Very strict.
This exemption applies only to income tax, not to Social Security or Medicare tax, which will still be withheld.
Right. FICA taxes still apply. The criteria are very specific and narrow, designed for those with genuinely no tax liability. You can claim exemption only if both of these situations apply.
Both conditions must be met.
For the prior year, you had a right to a refund of all federal income tax withheld because you had no tax liability whatsoever. And for the current year, you expect a refund of all federal income tax withheld because you expect to have no tax liability at all.
Zero liability last year and expect zero this year.
Correct. This isn't for everyone, and it's a common mistake for students or those with very low inconsistent income to claim this when they might actually incur a small tax liability.
Be careful with this one.
Very. The IRS even provides a helpful flowchart, Figure 1A in Publication 505, to help you decide if you can claim exemption. But note, you don't use that flowchart if you are 65 or older, or blind, or if you plan to itemize deductions or claim tax credits.
Special rules for certain groups.
Yes. In those special cases, you'd use specific worksheets like Worksheet 1.1 or 1.2 to help you decide. Or if you're itemizing or claiming credits, you'd use Worksheet 2.1 to confirm your tax liability is indeed zero.
So you need to prove zero liability.
It's really about pinpointing exact qualification. It's not a general option. To claim this exemption, you write the word exempt in the space below Step 4C on Form W-4.
Just write exempt.
And then you just complete Steps 1A, 1B, and 5, leaving all other steps blank. It's incredibly important to remember that this exemption is only good for 1 year.
1 year only.
You must give your employer a new Form W-4 by February 15th each year to continue your exemption for the new tax year. This annual renewal is a strict requirement.
Mark your calendar, Feb 15th to renew exemption. And here's a vital warning that cannot be overstated. If you claim exemption but your situation changes during the year, and you now expect to owe tax.
Like you get a better paying job.
For example, you get a new job with higher pay, or your investments start generating more income, you must file a new Form W-4 within 10 days of that change.
10 days, that's quick.
Very quick. Similarly, if you claim exemption for the current year but expect to owe for the following year, you must file a new W-4 by December 1st of the current year.
Need to anticipate next year too.
This is paramount for compliance and avoiding penalties. Claiming exemption when you don't qualify or failing to update your W-4 when your situation changes can lead to serious penalties and an unexpected tax bill. So use this powerful tool wisely and diligently.
Okay. Finally, let's turn our attention to the essential resources and assistance available to you directly from the IRS and other independent organizations.
Help is out there.
Definitely. Navigating the tax system can certainly feel complex, and these tools are specifically designed to simplify the process and provide support when you need it.
First up, leveraging IRS online tools and services. Your irs.gov account is a secure gateway to your federal tax account. Think of it as your personalized dashboard.
Your tax command center.
Pretty much. You can view amounts you owe, see payment plan details, make payments, view 5 years of payment history, access your tax records and transcripts, and even see digital copies of notices the IRS sends you.
Very comprehensive.
This is a powerful hub for managing your tax affairs, giving you a comprehensive overview of your interactions with the IRS.
And for those who qualify, there are fantastic free tax preparation options that can save you significant money on tax preparation fees.
Free help. Tell me more.
The Free File program at irs.gov Free File allows eligible individuals, typically those with lower to moderate incomes, to prepare and e-file federal returns using software or fillable forms, all at no cost.
Free file for qualified folks.
Additionally, the Volunteer Income Tax Assistance, or VIEIC program, offers free tax help for low to moderate incomes, persons with disabilities, and limited English-speaking taxpayers.
VIE. Okay.
Similarly, the Tax Counseling for the Elderly, or TCE, program provides free tax help, especially for those 60 and older, focusing on pensions and retirement issues.
And TCE for seniors.
These services can be immense tax savers by ensuring accurate filing and claiming all eligible credits and deductions you're entitled to.
And as we've highlighted earlier, the Tax Withholding Estimator at irs.gov W-4 app is another incredibly powerful tool.
Can't stress that one enough.
It's your interactive guide to making sure your paycheck withholding is just right. Not too much, not too little. Beyond that, the irs.gov website is a treasure trove of information. You can find all forms and publications directly on irs.gov forms.
Download anything you need.
Or order them to be mailed to you, or even get them as ebooks. The IRS also offers information in multiple languages and an accessibility helpline for taxpayers with disabilities, ensuring broad access to their resources.
Accessibility is important. Direct deposit for your refund is also the safest and easiest way to receive your money.
Faster than a check.
Much faster. And avoids lost or stolen checks. And for identity theft protection, IRS.gov Identity Theft provides crucial information, including how to get an Identity Protection PN or IPPIN.
The IPPIN, good protection.
Yes, it helps prevent fraudulent returns from being filed with your Social Security number, a vital defense in today's digital world.
This also raises an important point about independent advocacy. What if you have a problem the IRS isn't resolving?
Good question. The Taxpayer Advocate Service, or TAS, is an independent organization within the IRS that helps taxpayers resolve problems not solved through normal IRS channels.
An advocate within the IRS.
Yes, they can assist if you're facing financial hardship, an immediate threat of adverse action, or if the IRS hasn't responded to your inquiries in a timely manner. Their service is free, and they work to ensure your rights under the Taxpayer Bill of Rights are protected.
So they're on your side within the system.
Essentially, yes.
Yeah.
Acting as your advocate. And separate from the IRS and TAS, there are low-income taxpayer clinics, or LITCs.
LITCs, what do they do?
These independent clinics represent low-income individuals with tax problems, offering services for free or a small fee. They can represent taxpayers in audits, appeals, and collection disputes, and provide multilingual information on taxpayer rights.
More help available, especially for low-income taxpayers.
These resources are invaluable safety nets for ensuring fair treatment and correct resolution of tax issues, especially for those who might not be able to afford private tax assistance.
So we've come full circle. From the basics of how taxes are withheld from your paycheck, to the nuances of estimated payments for less common income streams, and the powerful tools available to help you.
It's a lot to cover.
It is, but it's clear that managing your taxes is far more dynamic and proactive than just filing a return once a year.
It's about being in control. Each decision you make regarding your withholding or estimated payments directly impacts your financial well-being,
Your bottom line?
helping you avoid an interest-free loan to the government or a penalty for underpayment. This knowledge empowers you to keep more of what you earn and make your money work for you, rather than letting it sit idly with the IRS or incurring unnecessary costs.
Absolutely. This deep dive into IRS Publication 505 wasn't just about understanding compliance, it was about empowering you to take control of your financial picture.
Taking the reins.
We've shown you how small, informed adjustments to forms like the W-4 can have a big impact throughout the year, influencing your cash flow, reducing stress, and avoiding unnecessary penalties.
And how understanding estimated taxes can prevent those unwelcome surprises, especially with varied income sources.
So, as you go about your day, we want to leave you with this thought. How might a small, informed adjustment to your W-4 today impact your financial goals for the rest of the year?
Something to mull over.
We hope this deep dive helps you feel more confident in taking those steps towards better financial control and, ultimately, peace of mind.